That's the chamber one, right? Okay.
Yeah. Hi everyone, welcome to the second speaker presenter for today. Today we have Nicole Albrecht. She's a really good friend of mine. She has been in the Valley for over 15 years, I believe. She has been in the tax practice for 15 years, however, and about 7 years ago they added the investment arm so that they could really help businesses and entrepreneurs take a big look at the entire picture instead of just pieces of the picture. She specializes in small business and entrepreneurs. That's where her passion lies, and she was also Citizen of the Year, so she's a local celebrity. So I'd like to help me welcome Nicole Albrecht. Thank you.
We'll be talking about taxes today. I know you guys are all really excited with the light. So as she said, Nicole Albrecht. I am with Financial Accounting Services, Managing Partner. And that's exactly what we do. We help empower our clients to make good, sound financial decisions. So this shit is complicated, right? Tax law is big. There's a lot of it. Actually, there's 74,000 pages of tax law written in 2013. That was over 4 million words. You can look every single year since 2013. It keeps getting bigger and bigger. And so our jobs as accountants is to bring that down to you at a level, layman terms, and only take the pieces that apply to you. So it is important that you're you're working with a tax professional that's specializing in your area or your business. We have a lot of wineries, so we specialize in wine. We have a lot of engineers, a lot of real estate agents. Someone that we don't do a lot of is farming. So we work with other tax professionals in our area to pair them up so that they're better. Welcome, guys. You missed my big entrance. That's okay. So Congress is still in session. So 2014, there's going to be a lot more tax law. What can you write off? Well, we're gonna make this very interactive. So if you have any questions, comments, concerns, throw up your hand. Ask me what you're thinking. I think you get a lot more out of it when you bring your real life scenarios into it, and that's what I'm here for. We're going to be talking about things that I write off. So I have an office in Temecula. Therefore, I don't write off my home business, or my office at home. I work out of the home, but I meet clients in my office in Temecula. So I don't write off a home office. We'll be talking about that a little bit later, what that looks like. Things I do write off, though, is I bought an iPad. I have a 16-year-old son. I love filming them. I love taking pictures of them. But I also use that iPad to read books, to research. I'll do PowerPoint presentations on that iPad. So I write off my iPad entirely, 100% for business. I have home internet at home. Now, yes, I watch Netflix and all that stuff on my home internet, but I also look up tax law. I'm constantly checking my emails, things like that. 100% I write off my home internet. I can do that because it's a flat rate. It's $50 a month, and I'm not paying per minute that I'm using it. So back in the olden days, you had to kind of keep track, 80% for business, 20% personal. We don't have to do that anymore with all these flat rates. My cell phone, I answer my cell phone for select business clients, have my cell phone number, and then also my team and my emails, my calendar, everything's synced up to my cell phone. 100% I write off my cell phone. And I want to buy my new iPhone, I write off that iPhone for the business. So these are perks for owning your own business. And we talk about people can come in and get a little bit crazy. If I'm looking at a real estate agent and they have $40,000 of income and they have $10,000 of meals and entertainment, that's not proportional. We're not going to take that. So we help educate you, and we help you go through those. What is appropriate, what's not appropriate. So we're going to talk about the 3 most audited tax items as a small business owner. And I call them the 3 M's, and how do I keep track of these? So we have meals, mileage, and merrymaking. It's actually entertainment, but I wanted to keep it 3 M's, so I looked up a fun alternative word for entertainment. You guys entertained. So for example, meals. Every Monday, I have a very good friend, some of you might know her, Jamie McNeese. She is one of my girlfriends. We go out to breakfast every single Monday morning. We pull out goals. Sometimes they're personal goals, sometimes they're business goals. but we're always talking about, what client she's working with this week, what clients I'm working with this week. I write off the entire breakfast at Denny's or IHOP or wherever we are. And on the back of my receipt, I simply make a bullet point of a quick item that we talked about, maybe the client that we talked about. We have a lot of mutual clients. And that's my written receipt that I file for the IRS. And I write off that 100%, I write off those meals. Now, when I do my tax return, I put in my $1,000 of meals. Tax code tells you you can only write off 50%, but you're going to give your accountant 100% of that, and then they'll make that adjustment on your tax return. So we also do, this morning I went with our office manager, Vicki, and I went out to Starbucks, and we're talking about leadership in our team and what that looks like and what books we're reading this year. And so we wrote that off, coffee at Starbucks. Simply just put a quick bullet point at the bottom of that receipt. I think bullet points are really important, what you talked about. And also your calendar. Your calendar is like your Bible. So if you go into an audit, you better have a calendar of meetings, times, dates, who you met with. We'll talk about mileage trackers. But that calendar, a lot of times if you don't have receipts, you need to save your receipts. But a lot of times the IRS will look at that calendar and allow a lot of stuff if you haven't been good at keeping your receipts. So that calendar is really, really important. Yes.
Would an electronic calendar suffice? Like,
yes.
You like a Google
As long as it's being backed up to the cloud or whatever, and usually you're getting audited. So right now, 2012 is what the IRS is looking at. You're getting audited for 2012s. So as long as you can go back and pull your 2012 calendar, or at the end of the year, I don't like paper, but print it and put it somewhere, or make sure you have an electronic backup somewhere. Because if Google decides to revamp their stuff, they could take down that whole calendar and move it.
I think you can, was it export, import it, right? All the information out of there? Yes.
Okay, perfect. Yeah, definitely that calendar is your Bible. So let's see, entertainment. So let's talk about some reasonable entertainment. I always like the clients that are going on a fun cruise with their husband or wife and they want to write off the whole entire thing. Then I have to ask them, you're a real estate agent. What, is it a real estate cruise? No, but we're going to look at property in the ocean. That doesn't make sense, right? Oh, I'm going to have a meeting that we're going to do our minutes on the cruise. No, well, that doesn't make sense either. Maybe you can write off the cocktail that you're drinking when you do your minutes, but that would be excessive. Here is some entertainment. This Friday, I went to the Del Mar racetracks with Rotary, and we took a bus. The bus was $40, and we went down to the Del Mar racetracks. I didn't write off my gambling, but I did write off a couple of drink beverages because I was having drinks with a couple of friends. I bought them some drinks, and we were talking about business, the community service stuff that we're doing. We talked a lot about the co-working week, and I simply just, when I got back and I was sober enough, I put a couple of good bullet points on the back of that receipt, and I handed it to Vicki, who keeps track of all those for us in our firm. Another really good tip is scanning. So I had a client that was getting audited with the IRS, and he had all of his receipts on a hot summer day in the car, and a lot of those carbon copies erased, and then there are blank receipts. Yeah. So I really like scanning. You can electronically file them in your filing cabinet. Makes a lot of sense. So scanning is a big one. But receipts are important, and people ask me, well, why if I have it on my bank statement that I went to Walmart? Okay, so you go to Walmart and you buy, paper and you buy ink cartridges, but how does an IRS agent know that? They just see Walmart for $15.75. It could have been underwear for your kids. So receipts are really, really important for that reason. Okay, so we also have auto deductions, which is better for me. So there are two different ways of keeping track of your auto deductions. You have actual and you have mileage. And everyone always asks me which is better. And I have no idea what you drive. It's my question. I would keep track of both of them and hand them to your accountant and then let them make the determination. They're going to take the better one for you. And so what we have is we have actual. And with actual, you have the cost of your car. Let's say you bought a $50,000 car. We divide it by 5. And we take $10,000 a year of the car. That's called depreciation. So we're able to take $10,000 a year of that actual car that you bought. Then we take your gas, your insurance, your DMV fees, your tires, your oil changes, and interest if you're financing that car. I don't believe in debt, but if you are financing your car, we can take the interest portion. What we do after that is you also have to keep track of your mileage. And you tell me, Nicole, I drove 12,000 miles that year. and I have 2,000 of them were personal, so I have 10,000 miles for the whole entire year. So we take the percentage of that, and that's what we take for the car. Does that make sense? So 80% of all your actual expenses we'll take on the tax return. So if that number is, let's say, $10,000, we take $8,000 is a business write-off, $2,000 is a personal expense, we don't get to use that. Mileage is a heck of a lot more simple. In 2014, it's 56 cents a mile. And if you had a Hummer gets about 9 cents a gallon. And a Prius gets about 50 cents, I'm sorry, a Hummer gets 9 miles per gallon. And a Prius gets 50 miles per gallon. So on a Hummer, if you drove 9 miles, you would get $5.04. So that's how that works out. If you keep track of both, your accountant can tell you which one's better for you. Basically, the Prius, you're going to get more bang for your buck taking the mileage. And for the Hummer, you'd probably get more bang for your buck taking your actual expenses. Does anyone have any questions about those?
What do you do when you have a combination? By that I mean, in the local area, when I go to the hospitals, I drive my car. But if I am in Denver, Colorado, I rent a car.
Okay.
So what I've been doing is I deducted as travel expense, in the travel expenses, the use of that car because I get the
Right.
billing
So
and I keep the receipts and all that stuff.
that's perfect. So on your car here for driving back and forth to the hospitals, you can take your actual mileage.
Right.
I drove 10,000 miles this year. You would get $5,600 worth of expenses. And then I had another $2,000 worth of rental fees and gas for renting a car. And so they would merge those two together. And that goes for a husband and wife that own a corporation. The husband, let's say, is the majority of the real estate agent. He does most of the stuff, but the wife occasionally makes deposits and might pick up supplies and goes to the accountant and maybe the bookkeeper. She can keep track of the mileage that she's driving around, and the husband can do the actual expenses on his car. So you can have multiple cars in a corporation, or in your case, in different locations. That's totally fine, as long as you have the backup. So everything comes down to backup. What do you have? If the IRS questions it, how can you provide them with receipts where they look at it and they say, that's reasonable, we'll accept that.
I have a question.
Yes.
I did, and I don't know if this is what I should have done, but I did a lease to my company. So I just wrote up a thing saying Impact Marketing is going to lease the truck from Beyond for X amount of dollars per month and pay any service fees and gas. And I just did that and just let it pay.
So you can do that. So let's say you said $500 a month. You then have to claim that $500 a month as income on your personal return, and you have to write off the car against that income. So it kind of convolutes the whole process. It makes it a little bit more complicated. We do have clients that do that. Sometimes it's a really good strategy if you have rental income and stuff like that. That could, that's going into higher strategies. But yeah, sometimes we do that because there's other income that we need to take care of on the tax personal return. But usually it's easier just to write in your minutes, I'm giving the car to my company, fair market value of my car, take the average Blue Book value is $20,000, and then start like that. It's a little bit cleaner. And we're all for making things easier, because the more complicated your mess gets, the more we have to pick through it, and then you get charged more. So simpler is always easier. It's cheaper, and it makes our lives a little bit easier.
I have a quick question.
Yes.
Obviously, if you're a consultant and you're going from client to client all day long, keeping track of all this miles is a huge pain. Do they have anything that can make that easier on?
I'm so glad you asked that. They do. They have a lot of free apps, mileage trackers, that basically you start it when you get in the car. You say, I'm going to co-working connection, and then it GPSes you around. I understand. Honestly, I know that 95% of my clients don't keep a mileage tracker or any type of mileage logs. This is what I usually recommend. Get a oil change in the beginning of the year and one at the end of the year. I understand they're back-to-back, but this is a legal documentation that we can walk into the IRS, and we have legal proof that you drove 10,000 miles for that year. And then, if you're keeping a really good calendar, we can MapQuest your calendar appointments for 1-2 months, and then I can walk into the IRS agents. This is why you pay a lot for a audit, because you have a trained professional and walk in and say, here's 1 month, we drove 1,000 miles. I basically times it by 12. That's reasonable based on these court cases. That's 12,000 miles. You can see he drove 15,000 miles in the whole entire scheme of things. So we took 12 for business.
Is it okay to use that Marquez mileage? Like I deduct always the time, the distance between my home, which is my business, where I have my business, to the airport.
Yep, that's perfect. I use MapQuest for everything.
Okay.
Yeah, definitely.
Have you seen anything where you can actually build it into your car, where you can track mileage?
No, but there is something on Friday called Shark Tank, and if you pitch that idea, I guarantee you, at least the accountants in the room will come up with, will back you on that. No, that would be awesome. Yeah, I mean, that's kind of the smartphone premises. And I say, for my clients, I do have clients that are good with it, so they put a little sticky on their dashboard, start your mileage tracker, and take it off. But mileage is one of the, especially if you're a real estate agent, mileage is your #1 audit ticket. They'll look on it and they'll say $10,000 worth of mileage, easy. They can write a letter saying prove your mileage, and then all of a sudden they know that most people don't keep a mileage log, and then all of a sudden it's a full-blown audit because your numbers aren't matching. So mileage is a big one, especially if that's a big part of your business. Keep track of it. Keep track of it, because you could be missing out too. I have some people that, I have some real estate agents. I have John and Joe, and they both made about 50,000 this year. But John has, 20,000 miles, and Joe has 8,000 miles. They sold the same amount of houses, so one of them's wrong, right? One of them's either underestimating and one's overestimating. They both probably are. But you're leaving money on the table at 56 cents a mile. That's basically $1 for every two miles that you're driving. So how do I track all this stuff? You need to track this stuff, #1. Shame on you if you don't. I like QuickBooks. We are QuickBooks certified pro advisors, so we train people on how to set up QuickBooks. It's very, very user-friendly, especially if you're a service-based entity. You're not selling products. QuickBooks is the program for you. You can also use Excel. You can use Mint. There are a ton of programs out there. There's free programs. But you should be tracking your income and expenses. On Thursday, I went through and I'm reading the book 80/20. So basically, 80% of your revenue is derived from 20% of your clients. And so I wanted to see who those 20% of my clients are and, touch them in some sort of way, not creepy, but, send them a little letter, something like that. So I ran my report in QuickBooks by customer sales, and I basically looked in a second who my top 20% of the clients are. And then we can come up with a marketing plan to touch them marketing-wise. If you're not keeping track of that, you don't know what's making you money, what's not making you money, the clients, your referral partners, you can track all this inside of QuickBooks. So I have people that call me and they want to come in for tax planning. Fabulous. I have to see a profit and loss to know where you are, income and expenses. And some people, will say, well, my books aren't up to date. I just got my taxes done. They're good through December. It is August, folks. You should know where you are in 2014. 8 months of the year have passed. You should have a rough idea what you're looking at. Maybe a little bit of cleanup work with an accountant. But I need to know, are we looking at $40,000 of profit or $150,000 of profit? And I would say probably about 20% of business owners can't answer that question for me. So if 5 people go out and start a business in 5 years, one business is left. That's just statistics. And usually the one that's left is the people that planned, that are working with professionals, accountant, legal team, and they're doing things right and they know where they are. You can't have goals with sales numbers if you don't know where you are income-wise. So enough about that. Track your stuff. Okay, so we have a saying in our, yes?
Very interesting.
Yes. So we have a saying in our firm, pigs get fed and hogs get slaughtered. And what that means is tax code is not black and white. In fact, Fred and I, my business partner, we went to an audit about 3 weeks ago. I've been practicing taxes for 15 years with Fred. We've had about 12 audits. This year we have 3, so audits are definitely picking up. The IRS is hiring, the state is hiring, they need money. So we went to an audit, and there was a very complicated item that was up on the audit. This would have been a $40,000 change in the tax return. And Congress makes the tax law, and then the IRS writes the forms and tries to interpret the tax law. The more complicated it gets, the bigger the gray area. Because we're educated, we could go in and we could say, I see that you're reading it like this, but this is how we're interpreting it, and here are court cases that go along with it. We won the audit because of that. So what I'm saying is, tax code is not black and white. It's not, yes, you can do this, no, you can't do this. It's, well, you need to buy an airplane and you're a real estate agent. Well, tell me a little bit more about that. Why do you have to buy an airplane? Well, because I'm in this club and I'm getting all these referrals. Can you track these referrals? Yes, I can. And I'm selling $1 million mansions, and I'm going over those mansions in the plane, and I'm showing them their property from the aerial view. So the more data and the more research we have, we can go out and look at these court cases to see, can you write off a plane in your corporation? That would be a gray area, and let's look at it and see if we want to take that risk or not. So what I'm saying about that is, definitely we don't take red at all. We're not going to sit there and open up our rest of our tax clients up because you want to write off $10,000 more for advertising because you don't like your tax bill. But there are very good gray areas that we'll definitely look into to make sure you're not paying a penny more. I hate paying taxes, and I'm sure you guys do too. And that's why we're here, for a team to help you do that. So the last, I know a lot of you were in here with the last one, and she talked about different type of entities. I'm going to go into that on the tax side of that. Is that okay? It's a little confusing, so I'm going to try and break it down as easy as I can, and we can make this very interactive. Oh, that's not fun. Okay.
Would you like something?
I would love, is this white thing? Can I use that or no?
Yeah, is it there?
Yep.
Yeah, that's it.
That's a good idea.
On the list now.
So basically, we'll start off with a Schedule C, or what a lot of people refer to as a sole proprietorship, a sole prop. I'm going to use red. I know that probably you shouldn't, but I don't have kind of partial to red. Is this a good spot here? Don't look at my butt. All right. Everyone files, or I can assume that most people in here file a 1040 tax return. 1040 is a summary of all the schedules behind it. So your 1040 is 2 pages, a summary of every single form behind the 1040. So you have your Schedule A, B, C, D, and it goes down the line. If you're a sole prop, sole proprietorship, you're filing a form called a Schedule C. It is hotter than hell in here.
Yeah, it's only warm too.
Dion, I'm sweating and I never sweat.
It's stupid.
Yeah, Schedule C. Like taxes are interesting enough to keep everyone awake. I need some air in here. Schedule C. Let's say, for easy math purposes, you make $100,000 net. So maybe you made $150,000 gross. You have $50,000 worth of expenses. Your net is $100,000. You'll see $100,000 right here on the front of the 1040. And I'm making tax law super, I'm bringing it down. Taxes don't work like this, but I'm going to compare apples to apples, so it'll make sense. Let's assume that you're in the 20% tax bracket federal, 5% for the state of California. So $20,000 in federal taxes, $5,000 in state taxes. And you get to write off your mortgage insurance, and if you're married with kids, so this doesn't work like this. And it's not a flat tax rate. It goes in brackets. But we're making it simplistic. What you have on top of this is something called self-employment tax. That's the killer, right? If anyone's ever been 1099 for the first time, they're like, what do you mean I owe $1,000? And I'm like, hey, buddy. And they're like, I only made $8,000. That's your self-employment tax. That's kind of the killer. That's about, this red stinks. It's about 15%. I'm rounding up or down, depending on who's in office. 15% is what you're going to pay on that. So that's another $15,000. Dion, what is going on?
I put another on your podium.
Oh, I'll take that one. Oh, it's blue. That's nice. Okay. So that's $15,000. Oh yeah, that works, guys. Can you see that? No? Okay. Oh, that's okay. I'll talk then. $15,000 on top of your $20,000, your $5,000, right? So CPAs came along. They got all excited. They decided if we file, I'm gonna talk about S corporations, LLCs work the same way. I'm not gonna talk about C corporations. Unless you're a Fortune 500 company or have a lot of investors who are foreign, C corporations usually don't belong in a small business atmosphere because of the double taxation. So this is an S corporation or an LLC, so we can say slash LLC, tax return. Totally separate tax return. And what happens is your $100,000, you made 150, wrote off 50,000, now we have $100,000. S corporation never pays any federal taxes. State tax is 1.5% or $800, whichever's higher, right? They're not gonna let you go whichever's lower, so $1,500, right? Then this 100,000 flows into a different line item on your 1040. You still pay your 20%, you still pay your 5%, you get rid of this 15% self-employment tax. Doesn't that sound phenomenal? You saved $15,000, you paid $1,500, but you saved $15,000. Well, third-party group came out and did a study, and they said Social Security is insolvent. It's paying out more currently, it's paying out more than what it's receiving as income, right? That's kind of the definition of on the pathway to bankruptcy. So this third-party group came out and said it's because of the S corp owner. We know that's bullshit, but that's what they said. So they caused the IRS to look at this. The IRS came out and said, okay, I see what you're doing here. You need to take fair and reasonable wages. Fair and reasonable wages. You need to work with your accountant to determine what that is. If you had to hire someone to do the day-to-day operations, what you do, what would you pay them? So let's see, I'm an accountant. There's a book you can actually go into and say, all right, if I hired an accountant, I would pay them in this area $35,000, $40,000. So if I make $100,000, I can take a W-2 of $40,000, and I can still save self-employment tax 15% on $60,000. Does that make sense? So there is a lot of tax savings in this strategy, but what's really, really important to note that you're not paying into Social Security and Medicare in that scenario, right? You're not pumping up that pot of money if you believe it's going to be there for your future. You're not paying into it anymore. So I believe it's extremely important to then fund your retirement, whatever your savings is. $7,000, if that's your savings, that $7,000 needs to go into savings or retirement for your future, because it's not anymore. So you're taking away from the government and you're putting it into your 401k plan and you're managing that money yourself. Does that make sense? So that's kind of the corporation. LLCs. Why I like LLCs, and I'm only giving tax advice, I'm not giving legal advice because I'm not an attorney. An LLC is a separate tax return as well. LLCs, we use them usually when there are partners that are unrelated. So not husband and wife, but for instance, me and my business partner, Fred Karma. We are unrelated, and an LLC works for us. If we make $100,000, let's say I'm working more and I take out $80,000 and he only takes out $20,000, we can separate that on an LLC, even if we're 50-50 owners. On an S corporation, if you're 50-50 owners, you're getting $50,000 of this, and he's getting $50,000 of it. So an LLC is really good for members that are not related. S corporation is what we typically use for husband and wife or sole practitioner. Another reason why LLCs, this is kind of the gray area of taxes. What happens to this $100,000? It comes out on a form called a K-1. You don't need to know that, but a K-1 comes out and feeds into this form. It's kind of like a W-2 form or a 1099. It's basically the same thing. Your accountant prepares this first, prepares the K-1. Your K-1 comes over here to your 1040 return, and that's where you pay your regular taxes. Now, the K-1 on an S corporation, not subject to self-employment tax, period. It's black or white. It is not subject to that self-employment tax at 15%. On the LLC K-1, it's very gray. We're not 100% sure. There's not a black or white answer. So some CPAs make it 50-50, 100% subject to self-employment tax. I've seen nothing subject to self-employment tax. So that's kind of a gray issue. I believe that because Social Security is insolvent, that the IRS or Congress will come out and say that LLC K-1 is subject to self-employment tax. So just something to look forward to in the future. Good news is LLC can be formed for a legal reason, and it can be converted to an S corporation. So you can still be taxed as an S corporation if that rule comes down the pipeline and you are an LLC, you can get out of it. Does anyone have any questions on that?
This one, you said LSCs where partners are not related with each other, that's where,
Usually we see LLCs in that. Because you always have someone that's working a little bit harder and pulling out more money in the company. But if you're 50-50 owner, your K1's gonna be 50% of the profits and his K1's gonna be 50% of the profits. So you get the one owner that's like, I was barely here. I didn't make any of that money. I sure as heck didn't get any money. I got 10,000 from the business this year. My K1 shows 30,000 and I have to pay taxes on that 30,000. An S corporation does that. But if you're both working the business and you're both taking out 50-50, then you're fine. There's no issues.
Another way to look at it is, an LLC would be would be appropriate for like an association with other companies.
Yep, yeah. Yeah, a lot of people use LLCs for multiple businesses under one entity, or a C corporation, they form it like that too. That's more of a legal issue. They're forming these umbrellas
Right.
for the corporate veil, but I don't talk about that because of the legal stuff. And I also know that corporate veil is pierced on a daily basis every time we write a personal check out of the corporation or a corporate check out of the personal. So I think we covered all that. I want to back up for a second, keeping everything separate. Even if you're just a sole proprietorship or a Schedule C, your bank account, you should have your own account just for business income and business expenses. It can still be a personal account, you can name it in your head, my business account, but everything should be separate for a couple different reasons. One, if the IRS is auditing you and asking just specifically for your business bank statements, and you have everything commingled, you've just opened up everything for the IRS audit, which is okay, but usually we're not fibbing or there's nothing to hide anyway, but it's just a lot more work, right? And then you're paying your accountant, at $250 an hour or whatever they're charging to represent you, and it just gets messy. Two, when you go to do your books, it is just a giant mess. You're trying to, here, that's personal. Oh, wait, there's a business one, and you're plugging all this in QuickBooks and things aren't making sense. Or your bookkeeper is charging you a lot more money because they have to add up all this stuff and separate everything out. Again, if I see Walmart, we do bookkeeping as well. It's not my favorite thing, but we do it for some select clients. If I see Walmart, you could have gone to the store and you could have gotten, copy paper and ink cartridges. I don't know that though, and you didn't give me any receipts, and I'm doing your bookkeeping after the fact, usually a year later. I'm doing 12 months of your bookkeeping. And I'm looking at that Walmart, and I'm saying, that's personal. Macy's, that's personal. I don't know you bought a business suit because you don't have the receipts, you know what I mean? So it's really important to separate those, and you could say everything's separate, nice and clean, 100% business, and then I know.
There is some sort of distance that you have to be away from your area where you have your business in order to use hotels or meals or what is that distance exactly?
So you're saying in order to deduct travel hotels and stuff like that, you have to be away from your place of business?
Right.
I'm not sure what you're...
Certain distance, like 50 miles or 60 miles, something like that. I don't know exactly.
I haven't
Again, don't
that.
use it nearby, if you say late, for instance.
Kind of like your meals, if you're so far away, your meals are either, if you're close, it's 50%, you can write off 50% of your meals. If you're X amount of distance away from your home, you can write off 100%.
Yeah, so, well, that's going into something called per diem, which is if you're a small business owner, we're taking everything as a write-off. That is going on a different form, and it's more of a W-2 employee takes that. But 50 miles is common for if you're away for travel or even moving, anything like that, you have to be 50 miles away. So that might be what you're referring to, but.
So it's 50 miles?
I don't know that exact. I don't know what 100% you're quoting. So, but I can get your email and look that up and get back to you.
Yeah, would you please?
I will, yeah.
Because I sometimes don't do it because I am not sure how far it would be. You know what I mean?
Right.
And I've stayed in hotels sometimes in LA just to avoid traffic, because it's too much
Right,
of a hassle.
yes, exactly. So yes, I will look into that and I'll get back to you on that, definitely. I go to LA and I deduct my hotel that makes you feel better. So there are a lot of new penalties for not filing on time. It is really important. A lot of people jump on LegalZoom or go talk to an attorney and form a corporation, and they forget to tell their accountant this. Are you yawning really in my class? Oh, God. Anyway, I'm kidding. I know, Sam. So if you form a legal corporation, tell your accountant. Give them the paperwork so they can set you up in the system. We automatically file an extension for you if we don't hear from you. Now, you could have gone somewhere else, but at least that's our safeguard. And a lot of people are just late. And there's nothing, if you file on time and then there's an extension on your name, that's okay. But it's a huge penalty for not filing on time. So a lot of times the corporation, the 1120S, your S corporation, is due March 15th. And a lot of times in April, I'm doing someone's personal taxes, and they're like, oh, hey, I forgot to tell you I incorporated. And I'm like, oh, hey, you're going to have a big penalty. So just make sure that you tell your accountant. Federal penalties right now are, I'm going to round it up, it's almost $200 a shareholder per month. So if you have 4 shareholders, that's $800 a month that you're racking up penalties. State all of a sudden was like, heck yeah, penalties, we're jumping on that. It's about $20 a month per shareholder. And then I talked about this a little bit in the other class. If you're getting all smart and you want to form a corporation in Nevada because you don't want to pay the $800 to do business in California, they will catch you. We see those letters go out every month. They will catch you, and it's a $2,000 penalty. So it's a huge deal right now. California is all over this to the point where they're even looking at, and I disagree with this, so we're writing letters to our state Congress. But if you have an LLC, a huge partnership, what they're doing is even if one member is only 2% owner and he lives in California, the state of California wants that $800 for that company, even if they're doing business in Delaware or Texas legitimately. So this is, if you think that you're doing business in California and you have a Nevada corporation and you're not going to pay the $800, they will find you. They will find you and hunt you down. Tax credit. So there are health insurance tax credits. Yes.
I'm sorry.
No,
There's
okay.
no loopholes anymore available from what you know?
No. And we were told from the state of California that they're coming after everyone right now. So basically how they find you, if you own real estate in California and you're listed on that statement of information, that's the yearly form that comes out that says who's your vice president or who are your members. If there's a California address on that form or the person owns California real estate, that's how they're linking them up right now in the systems. And we see the letters go out every month. Yeah.
And this may sound like a really dumb question, but.
That's
so
okay. We welcome dumb questions. I just point them out.
When you're filing, when you say failing to file, are you just mean you need to let your business accountant know from the get-go, like I'm planning to incorporate and this is what I'm doing?
Yes.
Okay.
So yeah, exactly. So I think about 5 or 6 years ago, it was really popular. I've heard it on the radio all the time. Form a corporation in Nevada because Nevada doesn't have any state taxes. In fact, if you have a corporation in Nevada, you don't even file a tax return in Nevada. You file your federal one, but there are no state forms. And so a lot of people jumped on that bandwagon. In fact, we had a lot of clients 6 years ago that had these Nevada corporations, but they're doing business in California. You have to file articles in the state of California, and there's a bunch of forms that you have to file every single year. And they want that $800. So that's what it means. It means, yeah, let your accountant know from the get-go or your business attorney, whoever you're forming that corporation with. I don't recommend LegalZoom. I know it's half the cost. We charge $15.50 to incorporate, and I think the paralegal before me said she charges $1,000 to incorporate. It's a big fee, but you want it done right. So I have a client that didn't talk to me, came in, and she had this Nevada corporation. So we could do a special filing and do it in California, but then you have to maintain all this stuff. So she actually spent $400 to shut down the Nevada one, and then another $1,500 to open it up in California. So I would just at least seek advice before doing it with an accountant and a legal professional. I think both are important.
There is something that if you go to another state and you work in another state, or you have a company in California, and obviously you form it in California and so on, but you work in another state for a period of time and you repeat the work, let's say 3 months later you go and work a bunch of days again, There's something in the tax code that says that you have to also declare taxes for that particular state.
Right. So we have a lot of, so the question was, I have a client that does business in California and occasionally he has some construction jobs in Arizona. He also has to file in Arizona that portion of the income. And so if you're not tracking your bookkeeping, how the heck do you know what income and expenses were for your Arizona jobs and what income and expenses were for your California jobs? So it's important to track both, and then yes, you have to file in Arizona and in California.
But if you do software, since you're not delivering that service there, like, you don't have to pay.
Correct, yeah. If you're developing the software here and they're purchasing it online and downloading it, you're not gonna have to file in every single state because you're developing it here.
Okay.
Yeah. Health insurance, there's a tax credit for it. If you're offering health insurance to your team, there's a tax credit for it. It's kind of complicated, and I don't know if everyone has a team in here. Is anyone interested in the tax credit for small business owners, or should I talk about the penalties for individuals? I'm going to talk about the penalties for individuals, because I feel like usually as small business owners, especially if it's just us, what's the first thing we cut? Health insurance, because it's crazy expensive, right? I pay $600 a month for my kid and we never even use it or go to the doctor. So I understand that health insurance is very expensive, but there's a penalty for not having it. Let me look to see where I am in my notes. The penalty, 2014 is the first time that this will go into effect. I have no idea what this looks like because the forms aren't even written yet, which is scary, right? Because in 4 months we're supposed to be filing these. But it's $95 a person, so husband and wife, you're looking at about $200, or 1% of your income. I think people fail to read that part. So they're thinking, yeah, $200, but if you make $100,000, that's a $1,000 penalty for not having health insurance. Still cheaper than having health insurance, I agree. 2015, it's 2% of your income, or $325. Kids is a little bit cheaper, but basically they're penalizing you for health insurance. So just know it's out there, just be aware of it. If you're filing your taxes, if you're husband and wife and you didn't have health insurance, you could be looking at, $200 more, and then next year, $800 more. So just keep it in the pipeline. Think about it. And if you have a small business owner and you're offering health insurance to your employees, there's a tax credit, so make sure you tell your accountant and they can tell you if you get it. Yeah.
So if you have health insurance through your other half, then there wouldn't be a penalty even though you don't have it through your business, right?
Right, because your husband has it on his W-2. Okay. Yeah, and that's the best of both worlds, right?
Yeah.
We just husband-wife team, basically, and health insurance through California, over California, whatever it is. That's deductible.
Yes.
And how much of that will be tax deductible?
If you and your wife are working in the business, 100% of the time, both of them are tax deductible. Yes.
Even though most stuff, she's 100%, 50% partner and everything.
Yes, yep, 100% is a tax write-off on your tax return.
Is there any limit on it? I'm paying about $300 per month.
No, if it's for you and your wife and you're both owners and operators in the corporation, it's a write-off as officers' health insurance benefits. The way it works on your tax return, your accountant can flush it out the way it works on the return, but it is a write-off, yeah. Health insurance, if you don't have some, get some. Tax planning, all right. So here are some tax tips that I like to utilize. Sometimes I like throwing these out in a one-on-one conversation because sometimes people take it and run with it, and I'm like, whoa, wait, we should have talked about that. A lot of people were going out and buying huge pieces of equipment, so I had my engineers that needed a new manufacturing equipment, so they were spending $150,000 last year. In 2013, they could write off that whole entire purchase of $150,000 instead of divide it by 5 and take a portion of it every single year. In 2014, they brought that down to 25 grand. So just keep that in mind if you're buying any big equipment purchases, that new limit is $25,000. You can still write off the whole entire $150,000. We'll take $25,000 now, and the rest carries forward, and you take it over 5 years.
That's federal?
Federal, correct, yeah. States been $25,000 forever, which is just very complicated because when state tax code and federal tax code don't conform together, it's a big mess. But yes.
But you just pick up a computer, for example.
Yep.
$1,000 computer.
Yep.
That's 100% accident or just?
So your accountant decides that for you. If you have a loss this year, I wouldn't take 100%. I would carry it forward in the future years when I have a profit. But if I'm, $300,000 profit this year, I'm gonna take that computer and write off the whole $1,000 this year.
Gotcha.
Yeah, but you can only do that in 2014 up to 25 grand. So if you bought 26 computers you can only take 25, that 26th one has to carry forward. Yeah, you don't lose it, it just goes into the future for 4 years. Yeah, so that's a big tax planning strategy that we were utilizing. That's the first question we asked, what big pieces of equipment do you need? This is why you saw a lot of real estate agents in 2005 with Hummers, because it was considered a big, heavy equipment, big piece of equipment, and they could write off the whole entire purchase of the Hummer in 1 year. I don't think that's smart because then they financed it probably over 10 years. So you write it off in 1 year, but you're still paying for it over 9 years. So you want to talk about that with your accountant. It might be fun and it sounds sexy. Yeah, I want to lower my taxes this year, but are taxes going up? Probably. They go up every single year, and we're pretty low taxes in the history of taxation. We're pretty low right now. And so why take that deduction now, all in 1 year, when you're still making payments on an item for over 5 years? That doesn't make sense, because then cash flow, you're laying it out, but you don't get that deduction anymore. Kids on payroll. So this is a tax planning strategy and technique. If you have a couple 10-year-olds running around, God help you, but you can put them to work. They can vacuum, they can clean, they can file, they can be out there holding a sign in this heat, they can put flyers around, they can market, there's a Facebook, they can do your social media, there's a lot of things that kids can do. And so what you can do, let's say you're making $300,000, you're gonna be probably about 40% taxes on your upper income. What you can do is you can give 5 grand to this kid, 5 grand to this kid. You can take $10,000 off your income. That saves you $4,000, right? If you're in the 40% tax bracket, your kids aren't going to pay any income taxes on that because they're in a 0% tax bracket at that level. So as long as they're working for it, it has to go through payroll. You can't 1099 them, but you can go through payroll, and they can take that money, and then they can buy because people are always like, oh, my kid wants to write off their soccer. Can we write off their soccer? Can we write off their football? No, but you can put them on payroll, and then the kids can pay for the football, the kids can pay for the soccer. Now keep in mind, if you're paying your kids, it's their money. So you can't do this all on paper and not give your kids this money, because eventually they'll see their social security statement and be like, hey, in 2014 I made 5 grand, where is that? Mm-hmm. So just make sure that either it's going into a savings account for them, or they're using it for their school clothes or whatever, their allowance money. But kids on payroll, I also think the kids should work for it, and they're supposed to work for it. So keep that in mind. Child labor laws don't apply if it's your kids. You can enslave them. So, retirement planning, we'll save that for the next slide. Home office deduction. Does anyone work out of their home? Solely out of their home? They don't have a, okay, perfect. You look excited about this one. Okay, home office deduction. What we can do, let's say we have a 100 square foot room and you have a 1,000 square foot house. I understand that's small, but it makes my math easy. That's 10%. I take 100, you don't have to know this, your accountant does this, I'm just explaining it to you. That's 10%. Now I can take 10% of your rent if you're renting, which is not a write-off. Now it's making it a write-off. You can take 10% of your mortgage interest, your property taxes, your utilities, home security system. Now lawn maintenance, I think, and cleaning, that's a little, obscene, but we can take a portion of everything, and that's a home office deduction coming right off your business. So you'll want to make sure that you tell your accountant, I have a home office, here's my square footage of the room I use. Now it's supposed to be a room with just an office, so there can't be a bed in there and everything like that. Say if you got audited, take the bed out, but you guys didn't hear that. Is this live? You need to have a home dedicated office and giving them, and you can't, your garage, your accountant can work that out with you, because you're not supposed to take a portion of your garage and all that stuff as well for storage and stuff. But home office deduction, it can be a very good deduction. It's an incredible deduction if you're renting, because you've taken something that you can't write off and now you can write it off. Your mortgage interest and property taxes you can write off anyway, so then you're getting a portion of your utilities. But there are some really good tax strategies to that as well. If you're in the upper income level and you have rentals and stuff like that, there's a lot of really good tax planning strategies with that. Questions on the tax planning? retirement planning. It's my favorite. So as a small business owner, there are a lot of perks that you can do with yourself. I'm going to pretend that no one has any employees right now, and I'm going to talk about the solo pay for a little bit. This is my favorite vehicle. We have a 401k with our plan at our work. The 401k, just for the paperwork nightmare, is $1,500 a year to manage that. It's kind of expensive, but it allows employees to go in and stuff like that. If it's just you and your husband or you and your wife, you guys can do, or you have kids on payroll, stuff like that, you can do what's called a solo K. It's exactly like a 401k plan, but it's $10 a year. And so let's take this scenario, $100,000. And let's say you're an S corporation, you're not going to pay any of the self-employment tax. We have $20,000 federal and $5,000 state, so you're paying 25% on income here. On a solo K, don't quote me because these things change every single year. You can defer $18,000 up to $49,000, maybe even a little bit more of income. So let's say this year you decide that you want to defer, you want to put $10,000 away for retirement. That would save you $2,500 in taxes because you're in the 25% tax bracket. So $10,000 in your pocket for retirement saves you $2,500 paying the IRS and state. So solo Ks, 401k plans, any type of money that you're putting away for retirement is a great tax strategy to reduce your income. So that's always a fun way for planning. Retirement, though, is for retirement. So Financial Accounting Services, the firm that we work for, is the only firm in Temecula Valley that's endorsed by Dave Ramsey. And in Dave Ramsey, we follow strict guidelines on how we invest. So it's important that we're not high in debt. We don't have debt. We have our savings account, and then we start investing. And that's where it makes the most sense, because what happened in 2005 is my real estate agents were making a ton of money, and they wanted to put $100,000 into, all these retirement plans. And then 2007, 8, 9 happened, and they weren't selling any more homes, and they had to live off that money. So not only was it a huge tax hit, penalties and taxes, but also they were buying in at $13,000, and then it dropped to $6,800. So they were claiming those losses as well. So they were only pulling out half the money, and then half of it was going for taxes and penalties. So it is really, really important that retirement is for retirement money. And you also have your emergency cash savings accounts. So that is retirement planning, and there's some extra things. We can get really high up and put $250,000 away if you need to into defined benefit plans, kind of like creating your own pension. Questions? Comments? Concerns? Cooled off in here, that's nice. Appreciate you all staying awake. Sam yawned, but that's okay. All right, guys, well, we have some some items. I think, did everyone get a little evaluation? Make sure you give me all 5s if that's the best one. We have a Social Security seminar. If anyone's interested, free at our office. So we have flyers back there. I also have 2 books our firm created for you. 57 Ways to Grow Your Business and the New Business Kit. We have a couple of them in the back. If you'd like one, just go see Sam, and she's passing them out. They're $100 each, but it's a signed copy. I'm kidding. We're giving away free. So if you guys would like those, they're in the back of the room. We have a couple of those that we brought just as a thank you for spending your time with us. And I'll stay here if anyone has any questions. And thank you very much. Appreciate it.
I learned that I need to work.
Right, exactly.
Well, your Social Security and your federal taxes all go to the same thing. Federal.
Okay.
So federal and state only.
So, there's no need to pay